Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, so let's jump right in. We are immediately wading into a really volatile, high-stakes scenario involving 3D Systems Corporation, ticker DD. The last few trading sessions, it's been holding this remarkably tight range, somewhere between, 170 and 185, often on heavier than average volume. But I think the stability is, it's completely deceptive.
It's the definition of a pressure cooker. On one hand, you have a company battling these just catastrophic financial fundamentals. I mean, a secular decline in its core business, a severe cash burn. And yet, the market structure is just completely distorted by this one extreme position. The short interest, it's sitting at a staggering 39,222,025 shares.
And that volume, that number, it points directly to our central conflict today. Is the trajectory of DDD primarily dictated by its structural decay, the insolvency risk, the disastrous balance sheet? Or is the price fundamentally governed by this mathematically hazardous anomaly created by the short interest, specifically that 23.05 days to cover metric that was reported just before the end of 2025?
Exactly.
My position is that the fundamentals, and particularly the deterioration of the capital structure, they are paramount. They have to be. They provide the only rational basis for any kind of long-term valuation. And this technical hazard is really just a volatility event attached to a distressed asset.
See, and I come at it from a different way. I maintain that when a technical position gets this extreme, this crowded, the company's underlying fundamentals, they almost become temporarily subordinate to the immediate liquidity dynamics. For the time being, the mechanism of a forced covering, I believe, overrides any traditional analysis of enterprise value.
Well, if we look purely at the fundamentals, we are faced with structural distress. This is not some cyclical downturn. This is a company facing a structural, secular decline in its industrial hardware business. And the figures they're stark. Sales have contracted by 6.3% annually over the last 5 years. This positions DDD firmly as a, quote, declining industrial hardware manufacturer, not some cutting-edge tech innovator that deserves a growth multiple. But the real threat, I think, comes from the debt restructuring. It has fundamentally changed the quality of the capital stack, and it's raised the probability of what some of us call a liquidity spiral.
Okay, that spiral is exactly what we need to unpack. So tell us why the debt swap, which, on the surface, it extended the company's maturity runway, why wasn't that a positive move? Why was it a structural disaster for the common shareholder?
The cost. The cost was staggering, both in cash and in collateral. So DDD swapped roughly $180 million of 0% unsecured notes that were due in 2026 for a smaller principal amount, $92 million, but they're 5.875% senior secured notes due in 2030. So yes, they bought time, but they introduced $5.4 million in new annual cash interest expenses into a business that's already burning, approximately $80 million a year in operations.
Right.
However, the change in status is the critical issue. The new debt is secured. This means the company is now a highly distressed borrower, using its most valuable assets, the intellectual property, the physical equipment, as collateral. This structural reality, it just fundamentally subordinates the common equity. It reduces its recovery prospects to basically zero in the event of default, and it accelerates that liquidity spiral. Higher interest expense accelerates the cash burn, which forces future equity raises at worse and worse prices, pushing the stock down towards $1.
I respect the clarity of that structural assessment. I really do, but I believe it frames the issue over too long a timeline. The fundamental distress is what attracted the shorts in the first place, but their success has now become a market-wide failure for them. They've created a binary outcome that's almost independent of any theoretical enterprise value for, say, the next 18 months. My focus is entirely on the immediate price action mechanics and specifically the days to cover, the DTC. When we talk about DTC, we're measuring the time in trading days it would take the current short interest to cover their entire position, assuming average daily volume. And the metric for DDC, it spiked from a manageable 0.10 days in October 2025 to a massive 23.05 days by mid-December.
Yeah.
23 days is a statistical anomaly. It defines what you'd call a critical liquidity event. To put that into context, nearly 32% of the public float, 39 million shares, is betting against this stock. If those short sellers all wanted to get out of their positions right now, they'd need over 3 weeks of typical market volume just to absorb that pressure. The exit door isn't just closed, it's effectively welded shut and covered in concrete. The volume simply isn't there for shorts to cover without catastrophic price slippage. And that risk, I think, overrides the 4-year insolvency timeline you're detailing.
Okay.
And that is exactly where the risk premium is generated. The shorts are trapped in a classic prisoner's dilemma. Any forced covering, let's say a single large hedge fund has margin issues, or a technical trigger crosses a key moving average, that would trigger a massive feedback loop. They'd be forced to cover into rapidly escalating prices. The volume required to close 39 million shares would spike the price purely on forced buying, likely driving it toward $3.50, maybe even $4. That immediate explosive threat is the material factor for anyone holding this equity today.
And that brings us squarely to the intersection of our arguments. The structural weight of secured debt versus the immediate mathematical pressure of that high days to cover. I acknowledge the DTC is dangerous for the shorts, objectively, yes. But I still maintain that the secured designation of the new 2030 debt acts as the ultimate ceiling on any sustainable valuation.
But hold on, why should a short-term price spike, even if it hits $4, be restrained by debt that's due 5 years from now?
Because it dictates recovery and the ability of the company to execute. That's why. When debt is senior secured, it means the creditors have a perfected lien on specific assets. So in a scenario where this business falters, which is a distinct possibility given the structural revenue decline, those senior secured note holders control the IP and the physical assets. The recovery for common equity holders goes to effectively zero.
Okay.
This structural reality makes DDD what some people call a poisoned pill for any large strategic acquirer because they'd have to retire that senior secured debt immediately. It fundamentally negates any long-term shareholder value proposition. You're holding stock in a company whose future growth and its ability to pivot toward innovation is collateralized against debt that now pays high interest. The value is capped not by future cash flows, but by the collateral value itself.
That is a compelling argument for the long-term structural integrity or lack thereof, but the technical threat is far more immediate and tactical. The high DTC doesn't just represent liquidity risk. It creates immense pressure right now through the cost of carry.
Explain that.
When a stock is hard to borrow, which DDD is, short sellers pay a significant borrow fee, a high cost of carry, which can be substantial on a 39 million share position. So if the stock simply trades sideways, bouncing between 170 and 190, those daily borrow fees slowly but relentlessly bleed the short seller's capital. This negative carry forces the bears to be deeply impatient. They need the stock to collapse now, not gradually over the next 3 years. This cost, it drives this psychological pressure to cover before that insolvency timeline you're talking about ever materializes. That mechanical pressure, it's what dictates the near-term price. And I think it overshadows EBDL or future interest payments. The shorts are the fuel for the fire here.
I think you're overstating the endurance of that mechanical pressure. Any spike driven purely by short covering is fundamentally unstable. It relies on momentum traders, not intrinsic value. And that brings us to our second point, the reliability of valuation metrics in a scenario like this. I mean, if we accept the premise that this is purely a mechanics game, why does any traditional valuation analysis even matter?
Precisely. Why do we even bother? We see these consensus figures, like the $3.63 average analyst target, which suggests a staggering, 105% upside from where we are now? I contend that figure is largely useless. It's anchored either to some theoretical liquidation value or maybe just stale expectations of a turnaround that hasn't happened. It proves the market cannot trade on normalized cash flows because, there are none.
Uh-huh.
The current market focuses purely on volatility. It's attracting what we call fast money traders, people operating on short-term price action and arbitrage, and they just exacerbate the stock's naturally high beta. Traditional valuation is absolutely irrelevant in a structural trap like this. The price is determined by the balance of fear between the short sellers and the retail speculators.
I would frame that a little differently. While that $3.63 target may be stale or speculative, the company's persistent valuation gap against its peer group shows the market is fundamentally pricing in the high solvency risk. DDD currently trades at a significantly discounted 0.7 to 0.8 times price-to-sales ratio. For context, its closest peer, Stratasys, trades at a much healthier 1.34 times PS.
Right.
This deep discount is the market's calculated acknowledgement of the $80 million annual cash burn and the heightened solvency risk from that secured debt. The market is saying, yes, there's IP here, but the management team is destroying capital faster than they're generating revenue. And furthermore, let's talk about the counter mechanism that prevents your 350 short squeeze fantasy from ever stabilizing. If a significant technical spike, your scenario A, actually occurs, that rally will be met with an immediate, massive equity offering. Management has every fiduciary incentive to sell into that short squeeze volume, using that momentary price inflation to replenish the company's precarious $140 million cash balance.
Okay.
This guaranteed dilution risk. It acts as a functional price ceiling. The company will raise capital at the expense of temporary shareholders to protect its own balance sheet, ensuring that any mechanical squeeze is capped and reversed almost instantly.
You are introducing an element of management prudence into what is really a mechanical argument that assumes institutional panic. But let's look at the third pillar of your fundamental thesis, which I believe is entirely ignored by the current market pricing: operational health and governance.
It is critical that we discuss the long-tail risks threatening any fundamental turnaround, completely separate from the debt structure. We have to look at operational execution. The company reported significant inventory mismanagement, evidenced by a 23% drop in sales of high-margin materials. Materials sales are the recurring high-gross margin part of the business. A failure here starves future R&D and undermines their ability to service the hardware they've already sold.
Right.
And then we have the governance friction and the so-called brain drain. Management has implemented rolling layoffs and merit freezes, all branded as efficiency programs.
And what's the real cost of those efficiency programs?
They erode human capital. They erode institutional knowledge. These specialized companies rely entirely on their innovation velocity to stay ahead of commoditization, especially in core tech like SLS and SLA. If you are freezing merit raises and pushing out key engineers, you are undermining the only true hedge this company has against its hardware being rendered obsolete. And when you compound this with poor governance, like a CEO pay ratio that's reportedly 29-1 compared to the median employee, it just signals a deep disconnect between leadership rewards and shareholders' suffering. These are the issues that cause the business to fail over the next few years, regardless of what the short interest does in the next few months.
While I acknowledge those operational issues, inventory, employee morale, governance optics, they're serious problems for a viable going concern. I just don't believe they are currently the most material factor for anyone holding the stock today. These long-term issues only become relevant if the company survives the liquidity trap. The current trading situation is purely a binary option. You're speculating on corporate survival driven by external market mechanics. The near-term pressure of the crowded short position, that 31.93% of the float that is trapped, is the overwhelming factor. When a trade is this structurally unbalanced, the mechanics overshadow everything, even inventory mismanagement or the CEO's salary, until that short pressure is released. The market is not buying a 5-year turnaround, it's buying volatility.
And that ultimately is the inherent tension that defines this equity, isn't it? We are evaluating a distressed asset that is tracked between two opposing extremes. My position remains firm. While the short squeeze potential is not only real, but I'd argue highly probable given the 23.05 days to cover, the structural decay is the deciding factor for long-term holders. The transition to senior secured, interest-bearing debt and the persistent lack of operational cash flow, it means the long-term trend remains downward. This is a distressed asset whose fundamental solvency risks make it unsuitable for any traditional investment portfolio. The financial reality of being a secured borrower, of having your most valuable IP collateralized, that is the structural anchor that prevents sustainable recovery, no matter what kind of short-term volume spikes we see.
And I will reiterate the extraordinary technical risk that defines the next 18 months for this stock. That 23.5 days to cover, it's not just a high number, it represents a significant market structure distortion that holds the potential for a massive, if brief, price dislocation. For those entering the name today, the trade is explicitly a speculation on market mechanics and forced covering, not on cash flows or future operational improvements. While institutional capital with rigid risk mandates should absolutely avoid this name because of the liquidity and fundamental risks, the high binary risk-reward remains the primary driving force for the current price action. That liquidity trap is the monster under the bed.
So DDD is a classic example of an equity that demands a dual analysis, trapped as it is between extreme fundamental risks and extreme technical hazards.
Right. It leaves this serious investor in a difficult position, weighing the immediate, explosive danger of the short liquidity trap against the long-term, corrosive reality of structural insolvency. The debate isn't whether the company is healthy, but which extreme factor is going to dictate the price first.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.